Listen carefully. If you own silver or if you have been watching the global economy with growing concern, what I am about to discuss deserves your full attention. I am not talking about a normal commodity cycle. I'm not talking about another temporary surge driven by speculation, social media enthusiasm, or a short-lived burst of investor optimism. I am talking about a structural shift that may already be underway beneath the surface of the financial system. Most people still evaluate silver through the lens of the last several decades. They look at historical price ranges, they compare silver to stocks, they focus on quarterly performance, interest rate decisions, and short-term market sentiment. But that approach may be becoming increasingly dangerous because the environment that shaped those assumptions is changing. You need to understand what is happening. For years, the global economy has been supported by one powerful force: expanding debt. Governments borrowed more, corporations borrowed more, consumers borrowed more, and every time instability threatened growth, policymakers responded with additional liquidity, lower rates, larger deficits, and more intervention. At first, these measures appeared effective. Markets recovered, confidence returned, asset prices moved higher. But every cycle created a new problem. Each intervention increased dependence on future intervention. Each rescue required a larger rescue later. Each expansion of debt reduced the flexibility of the system itself. History has shown repeatedly that debt can create prosperity for a period of time. What history also shows is that debt eventually creates constraints. The real question investors should be asking is not whether debt matters. The real question is how long a debt-dependent system can continue functioning before confidence begins to weaken. Because confidence is the foundation of modern finance. Currencies depend on confidence, government bonds depend on confidence, banking systems depend on confidence, financial markets depend on confidence. And when confidence starts to erode, even gradually, the consequences can become significant. Most people never notice the early stages. They wait until the evidence becomes obvious. They wait until headlines begin discussing problems openly. They wait until major institutions publicly acknowledge risks that had been building for years. By that point, much of the repositioning has already occurred. This is why understanding the broader picture matters. Around the world, governments continue operating with substantial deficits, debt levels continue climbing, interest expenses continue consuming larger portions of public budgets, central banks remain trapped between competing objectives. They want economic growth, they want financial stability, they want manageable inflation, they want sustainable debt markets. But those goals increasingly conflict with one another. That is why the policy environment has become more fragile. Every decision creates trade-offs, every intervention creates new distortions, every attempt to solve one problem often creates another. You can already see the signs. Financial markets react aggressively to policy changes, liquidity conditions influence nearly every major asset class. Confidence remains intact on the surface, but underlying vulnerabilities continue growing. This is not a prediction of immediate collapse. It is an observation about long-term pressure. And pressure matters because pressure accumulates. It builds quietly, it develops beneath the headlines. Then eventually something changes, a catalyst appears, a policy mistake, a credit event, an economic slowdown, a confidence shock. No one knows the exact trigger, but history suggests that heavily leveraged systems rarely move from stability to instability in a perfectly smooth manner. That brings us to silver. Most investors still think of silver primarily as an industrial metal. They focus on manufacturing demand, they focus on technology applications, they focus on economic growth projections. Those factors matter, but they are not the entire story. Silver occupies a unique position. It is both an industrial asset and a monetary asset. That distinction becomes critically important during periods of monetary uncertainty because when confidence in financial structures begins to weaken, investors often reassess what they consider valuable. They begin searching for durability. They begin searching for scarcity. They begin searching for assets that exist outside traditional financial promises. This is where silver becomes increasingly relevant, not because silver itself changes overnight, but because investor perception changes and perception influences capital flow. Many investors underestimate how quickly capital can move once a narrative begins shifting. For years, money may ignore a sector, then suddenly attention returns, allocations change, institutions adjust exposure, portfolio managers reassess risk, and markets that once appeared insignificant become increasingly important. The Silver market is relatively small compared with global pools of capital. That fact alone deserves attention because when large pools of money attempt to enter smaller markets, price movements can become amplified. Supply cannot always adjust immediately. Demand can increase rapidly. Volatility can expand. Momentum can strengthen. The result is often a repricing process that surprises investors who relied exclusively on historical expectations. This is why the phrase repricing cycle matters. A repricing cycle is different from an ordinary rally. It reflects changing assumptions. It reflects changing confidence. It reflects changing perceptions about the future. And when those changes occur simultaneously across large groups of investors, outcomes can become far more significant than most people initially expect. That is exactly why silver holders should be paying close attention today, because the forces driving this discussion are not short-term. They are structural. They involve debt. They involve monetary policy. They involve purchasing power. They involve confidence. And most importantly, they involve the possibility that investors around the world may begin viewing monetary assets through a very different lens than they have for much of the last generation. The question is not whether these pressures exist. The evidence is already visible. The question is how markets will respond if those pressures continue intensifying. That is where the next stage of this story begins. You need to think carefully about what happens when the financial system reaches a point where confidence becomes more important than growth. Most investors have spent their entire careers operating in an environment where intervention was expected. Whenever markets faced stress, support arrived. Whenever liquidity tightened, policymakers responded. Whenever risks emerged, new measures appeared to stabilize conditions. That pattern created a powerful belief, the belief that stability can always be managed, the belief that authorities will always have another solution, the belief that every problem can be postponed indefinitely. But history does not support that assumption. History shows that every long-term debt cycle eventually encounters limitations. Not because policymakers lack intelligence, not because institutions stop trying, but because mathematics eventually becomes more powerful than narrative. Debt grows, obligations expand, interest costs rise, stores become constrained, and flexibility begins disappearing. This is where many investors make a critical mistake. They focus exclusively on visible events while ignoring the forces developing underneath those events. They watch headlines, they react to market fluctuations, they follow daily commentary, but they rarely examine the structural pressures shaping the environment itself. Those pressures matter far more than most people realize. Consider what happens when debt expands faster than productive growth for extended periods. The system becomes increasingly dependent on lower rates, higher liquidity, and continued confidence. Each of those factors supports the others, but each also creates vulnerability because once confidence weakens, maintaining the balance becomes significantly more difficult. This is not a theoretical concept. It has appeared repeatedly throughout financial history. Periods of stability often encourage behavior that eventually undermines that stability. Risk-taking increases, leverage expands, dependence grows, participants begin assuming favorable conditions are permanent, then reality changes. And when reality changes, markets must adjust. The adjustment process is rarely comfortable. It often involves volatility, it often involves uncertainty, it often involves rapid shifts in investor psychology. That psychological component is particularly important because markets are not driven solely by data. They are driven by perception. They are driven by expectations. They are driven by confidence. When confidence is strong, investors tolerate risks they would otherwise avoid. When confidence weakens, those same risks suddenly appear unacceptable. The assets investors once ignored become attractive. The assets investors once chased become questionable. Capital rotates, priorities change, narratives evolve. This is why transitions can accelerate unexpectedly. At first, only a small number of participants notice the shift, then more investors begin paying attention, then institutions begin adjusting, then momentum develops. Eventually, what seemed impossible begins appearing increasingly reasonable. This dynamic is particularly relevant to silver. For years, silver has occupied an unusual position in financial markets. It's often been overlooked. It has frequently been underestimated. Many investors became frustrated by periods of underperformance. Others stopped paying attention altogether. That neglect may prove important because neglected assets often attract little attention until conditions change, then suddenly they become impossible to ignore. The reason is simple. Markets tend to focus on what worked recently. Investors become anchored to current trends. They assume the future will resemble the recent past. But major transitions rarely emerge from consensus thinking. They emerge from changing realities, and changing realities can force markets to reassess assumptions very quickly. If confidence in debt-heavy financial structures begins weakening, investors may start prioritizing protection over performance. That distinction matters enormously. During optimistic periods, investors often seek maximum returns. During uncertain periods, investors often seek durability. The objective changes, the psychology changes, the allocation process changes. And when that happens, assets associated with monetary protection frequently receive renewed attention. Silver has historically benefited from that type of environment, not because it generates cash flow, not because it relies on promises from governments or institutions, but because it represents tangible scarcity. Scarcity matters when confidence becomes uncertain. Scarcity matters when purchasing power becomes a concern. Scarcity matters when investors begin questioning long-held assumptions. This is why discussions about silver cannot be separated from discussions about the broader monetary system. The two are connected. The condition of the system influences the perception of monetary assets, and perception ultimately influences demand. Most investors underestimate the speed at which that process can unfold. They assume major shifts happen gradually. Sometimes they do, but sometimes they happen through recognition events or realization spreads. A narrative changes as risk becomes widely understood, and suddenly behavior adjusts. That is why waiting for universal agreement can be dangerous. By the time everyone reaches the same conclusion, the opportunity often looks very different. The market may already be responding, the positioning may already be occurring, prices may already be adjusting. This does not mean every prediction becomes reality. It does mean investors should remain aware of structural developments before they become mainstream discussions. Right now, several long-term trends deserve attention. Debt continues rising, fiscal pressures continue expanding, core purchasing power remains a concern, financial systems remain heavily dependent on liquidity, policy flexibility appears increasingly limited. None of these factors guarantee a specific outcome, but together they create an environment where traditional assumptions deserve scrutiny. And that is exactly why the possibility of a major repricing cycle continues attracting attention from serious macro investors, because repricing events are rarely caused by a single factor. They emerge from multiple pressures converging simultaneously. They emerge when confidence, policy, liquidity, debt, and perception begin interacting in new ways. Silver sits directly at the intersection of those forces. That does not guarantee immediate movement. It does not guarantee a straight path higher. Markets never move in perfect lines. There will be volatility, there will be disagreement, there will be periods where the thesis appears early. But structural changes often begin long before they become obvious. The investors who understand the reality tend to focus less on short-term noise and more on long-term condition. And those conditions are becoming increasingly difficult to ignore because beneath the surface of daily headlines, larger forces continue building. The question is not whether those forces exist, the question is how powerful their eventual impact may become once the broader market fully recognizes them less carefully. The biggest mistake investors make during major monetary transitions is assuming they will receive a clear warning before conditions change. History suggests otherwise. Most significant financial shifts begin quietly. The evidence appears long before the public recognizes its importance. The signals emerge before the headlines. The pressure develops before the reaction. And by the time the majority realizes what is happening, the environment has already changed. That is why understanding the difference between price movement and structural repricing is so important. A normal price movement occurs within an existing framework. A structural repricing occurs when the framework itself begins changing. That distinction is critical because when the framework changes, historical assumptions become less reliable, traditional valuation models become less useful, investor behavior becomes less predictable, markets begin responding to forces that previously received little attention. This is where many people become confused. They continue evaluating the future using conditions from the past. They assume tomorrow will function like yesterday. They assume the financial architecture supporting markets will remain unchanged. But financial history shows that no system remains unchanged forever. Every monetary regime evolves. Every debt cycle reaches a stage where adjustment becomes necessary. Every period of apparent permanence eventually encounters pressure. The only uncertainty is timing. That is why serious investors pay attention to underlying conditions rather than relying exclusively on surface-level stability. Surface-level stability can be deceptive. Markets can appear healthy while vulnerabilities accumulate. Confidence can appear strong while strains continue building. Growth can appear resilient while imbalances quietly expand underneath. Eventually, those imbalances demand recognition, and when recognition arrives, reactions can be dramatic. Consider what happens when investors begin questioning assumptions they once accepted without hesitation. Assumptions about debt sustainability, assumptions about monetary policy effectiveness, assumptions about purchasing power, assumptions about long-term financial stability. Once those assumptions weaken, capital behavior begins changing. The process may start slowly. A few investors diversify, a few institutions adjust allocations, a few portfolio managers increase exposure to tangible assets. But shifts rarely remain small forever. If confidence continues deteriorating, participation expands. More investors reposition, more institutions respond, more capital begins searching for alternatives. That search itself can become a powerful market force. And because silver exists within a relatively constrained market, even modest reallocations can create significant effects. Many investors fail to appreciate this reality. They assume large moves require universal participation. In truth, major repricing events often begin with a relatively small percentage of capital changing direction. When supply is limited and demand begins increasing, the balance shifts, discovery changes, volatility expands, momentum strengthens, the market begins operating under a different set of expectations. This is why discussions surrounding a potential large-scale silver repricing are not solely about silver. They are fundamentally about confidence, confidence in currencies, confidence in debt markets, confidence in financial institutions, confidence in policy responses. The strength or weakness of that confidence influences nearly every major investment decision, and confidence can change faster than many people expect. For years, a system may appear durable. Then a catalyst exposes underlying vulnerabilities. Suddenly, risks that seem manageable appear much larger. Assumptions that seem permanent appear questionable. Narratives that dominated for years begin losing influence. When that process unfolds, investor behavior often changes rapidly. Preservation becomes more important than optimization. Resilience becomes more important than growth projections. Scarcity becomes more important than promises. That transition can have profound consequences for asset allocation. It can also have profound consequences for silver because silver occupies a unique position between industrial utility and monetary relevance. When monetary concerns arise, that relevance often receives renewed attention, not because investors suddenly discover silver, but because changing conditions force a reevaluation of what matters. This reevaluation is often uncomfortable. It challenges existing beliefs, it challenges existing strategies, it challenges assumptions that may have guided investment decisions for years. Yet financial history repeatedly demonstrates that adaptation matters. Conditions change, systems evolve, markets respond. Investors who recognize those changes early are often better prepared than those who wait for universal confirmation. That does not mean acting emotionally. It does not mean chasing headlines. It does not mean abandoning discipline. It means understanding the environment objectively. It means recognizing structural developments before they become obvious. It means paying attention to long-term trends rather than becoming distracted by short-term fluctuations. Today, the long-term trends remain significant. Debt burdens continue expanding. Fiscal challenges continue growing. Purchasing power concerns remain relevant. Liquidity remains essential to market stability. Policy options appear increasingly constrained. Together, these factors create an environment that deserves serious consideration, especially for investors concerned with wealth preservation. It's especially for investors seeking protection against monetary uncertainty, especially for investors attempting to understand where capital may move if confidence weakens further. That is why the conversation surrounding silver continues gaining importance, not because of excitement, not because of speculation, not because of temporary enthusiasm, but because structural pressures continue building beneath the surface of the global financial system. And history suggests those pressures rarely disappear on their own. They accumulate, they intensify, they eventually demand adjustment. The timing remains uncertain, the path remains uncertain, but the underlying forces are visible. That is what matters most because investors who focus only on current conditions often miss the larger transformation taking place around them. Meanwhile, investors who study long-term cycles understand something important. Major repricing events are rarely obvious at the beginning. They become obvious only after they are already underway. That is the lesson history teaches repeatedly, and it is the lesson every silver holder should keep firmly in mind as the next chapter of the global monetary story continues to unfold.